Good morning, this is Mark Boud from Real Estate Economics. I welcome all of you who are joining us for our weekly webinars for Real Estate Economics. It is Wednesday, August 18th, 2010, and our webinar this morning will cover the second half of a California State webinar that I began last week. And I have a lot of information to cover with very little time, and so I'm just going to very quickly share with you the webinars that are coming up. Denver, Colorado will be next week. We don't have this posted, but the week following that will be Ventura County on September 1st. And you can pull up all of our webinars anytime you'd like at YouTube/Real Estate Economics. And most of the information that I share with you this morning can be retrieved from our Residential Economic Report. Not only is it available on a statewide basis, but it's available for every major metropolitan area through the nation. We hope you'll take advantage of that. And we're offering a special offer. Those of you who are interested, please contact us, my associate Judy Duell or Sandy Rivera. And I'm just going to very quickly take you through the slides that I went through last week. If you missed that presentation, you can pull that up on YouTube. But just a very brief summary as to what's going on. Here we are at part 2, where the first thing I want to do is show you some regional comparisons of California State, which is shown here right in the middle relative to a lot of other areas where we do a lot of consulting. What you can see is we show that overall California State is about 5% oversupplied. That's not necessarily because we're building too many homes. We're actually building very few homes right now. It's mainly because, or a reflection of the number of jobs we've lost during the past several years. We are also about 28% undervalued in California. To put that in perspective, about 58 cents of every dollar of median income was represented by mortgage costs back in the year 2006. Right now it's about 30 cents. Now 30 cents is far higher than what we pay on a national basis of 17 cents, almost twice as high, but it's extremely low for the state of California. In other words, California right now is really on a fire cell. This is about as low as you've ever seen it in California. And because of that, we're seeing a lot of sales volume. Sales volume is still trending upward, not as fast as it was, but we're still seeing gains in sales volume and even some price appreciation or increases in median values in many areas. We're down about 49% in terms of housing costs from where we were at the peak. And so when you cut the housing costs in half in California, it makes it a bit more affordable, and a lot more people enter into the market. Right now, the improvements that we've experienced during the past 6 months are almost totally due to affordability as opposed to economic growth. We just haven't seen economic growth yet. In terms of what that looks like graphically, California, here at about 50% drop in overall value relative to year 2006. The United States as a whole is about a 38% drop. So the entire nation is really affordable relative to where we were just a few years ago, especially the state of California. And you can see that California is well represented in those areas that have dropped the most: Sacramento, the Inland Empire, Los Angeles, San Diego, and so on. Okay, I'm going to very quickly describe the mass. I've done this before, but what this shows is the change of jobs in California, which is shown by the blue bars on an annual basis from 1970 to our estimate for year 2010. Relative to housing construction. And as you can see, there are various recessions that we've had in the past. This current recession, which is quite severe, being caused by the credit crisis. What I want to do is also overlay those recessionary periods relative to what the housing cycle has done in terms of volume, shown in red, and price, shown in blue. Blue is the median price, red is the overall sales volume. What you'll first notice is that when we have a peak or a trough in sales volume, usually 1 to 2 years after that we have a peak or a trough in price. And so sales volume, changes in sales volume always precede a change in price. We saw that most recently with a trough in sales volume in January of year 2008. Since then, sales volume has recovered pretty nicely. We're about where we should be right now. That was followed by a trough in price back in May of year 2009. Since then, it's trended up in most areas. So let's wipe that clean and see really what should have happened based upon a normal cycle. What should have happened is we should have dropped in terms of sales volume during the recession of that followed the dot-com bust. And we should have normalized and then dropped in price quite a bit. And so everything that really occurred after year 2001, 2002 is really, in my book, an anomaly. This aberration occurred both in sales, or first in sales, then in price. That caused a lot of problems that led up to the enormous crash that we saw, not only in California but on a national basis, because we didn't correct the way we should have. And the reason we didn't correct is because we were funneling a lot of money from Wall Street and other liquid assets into the real estate market. It was seen back in the early 2000s as a safe haven for money, partly because Wall Street was not treating the smaller investor very fairly, and partly because we had loosened lending practices so much that it was extremely easy to enter into the market. So we created a lot of artificial demand because of these national loosened lending standards, and you can see how loose they became from 01 to 08 by looking at the loan-to-value ratios, by looking at 100% financed loans, which just skyrocketed by 2006. Limited documentation loans, or liar loans, were almost half of all loans by 2006. And the combination of those two should have never got to such a high level. We've taken care of that. In fact, we've overcorrected quite a bit with very tight lending practices. Now we're trying to recover from that. But suffice it to say that a lot of the problems we faced were due to allowing far too much money flow into the real estate market from non-traditional demand, or really artificial demand. In terms of job growth on a 12-month basis, or job change, you can see where we are right now. We've made some improvements in terms of reducing the amount of jobs that we're losing, but we're still a few months from positive job growth. In fact, we don't think that happens till about the beginning of next year. And that's a little bit behind where we are on a national basis. Where on a national basis, we think we'll see those year-to-year gains in overall job growth by fourth quarter, maybe even third quarter of this year. So what drives this economic cycle? We have some some people think are somewhat aggressive job forecasts for this next cycle. Part of the reason, or part of what goes into those forecasts, are those elements that we see driving that next cycle. And one of those is the stimulus package. We don't talk about that much. Whether it's positive or negative, it's a lot of money pouring into the system, and a lot of it hasn't filtered down into the economy yet. We're spending about half of that stimulus package this year, which means that after taking about 6 to 12 months to filter through the system, most of the impact of that isn't felt until next year. And so the stimulus package still has a big impact. Most of the impact is felt next year. This shows you the various elements of the stimulus package. Also, the medical industry, the pharmaceutical and biotech are all drivers. All three of those, we think, do fairly well, partly because of this maturing population that we have in California and throughout the United States. Renewable energy is becoming a bigger deal, both in terms of how it impacts the housing industry, even more so in terms of how it impacts the automobile industry. And just to give you an example, most major car manufacturers are coming up with automobiles that will get over 100 miles per gallon during the next 3 years. What happens with that is you reduce your energy costs from fossil fuels, which cost about 35 to 40 cents per mile, down to about 4 cents per mile for an electric car. And that's a big difference. And once you bring those electric cars to a price level where they can be afforded, you get an enormous turnover in the automobile industry. And we think that in and of itself is a large driver. There's also importing and exporting activity going on. There's new energy technology, which is a little bit farther off, but certainly plays a role in the next couple of cycles. And increasingly, these drivers are gaining ground, and we think that within the next 3 or 4 years they'll be established enough where they really begin to get the next cycle off, the next economic cycle in full steam. Okay, California 5-year forecasts. And I'm sorry I'm talking so quickly, but I'm going through this quickly. The number of jobs, where we are right now is far lower than where we were about 4 years ago at the peak of year 2007. You can see the 12-month change here. Most of those jobs were lost in 2009. Overall, annually, it's a big loss in 2010. Year 2011 is the first positive year on an annual basis, and it grows from there, a new economic cycle for reasons I mentioned. In terms of overall housing supply, I discussed this in detail last week, and what I wanted to point out this week again is that despite the fact that we're building very few homes, there's also distressed inventory in the system that you need to account for. That makes it feel like there's far more supply than there really is on an incremental basis in our system. As the distressed inventory burns off, despite the fact that we'll be building more new homes during the next few years, we'll actually experience 3 or 4 years of very, very low supply levels. That'll be a good thing. It allows demand to catch up with supply and the overall market to correct. Here's where we are in terms of mortgage rates. I was quoted at a 4.41 fixed rate for a 30-year loan. That's as low as I have ever seen it, and we think it bumps along that bottom for about another 12 months before economic growth on a national basis begins to force it to rise in tandem with that national economic growth. It'll take until about 2015 until we even play with about 7% again, which historically used to be considered a low rate. In terms of population growth, here's that bulge we see in the 55 to 74-year-old range. A lot of mature households being created during the next 5 years. That has ramifications for the types of homes that you want to build. In terms of how that impacts overall demand and supply for housing, in California, the demand curve is this green curve. The supply curve is the blue curve. When there's a difference between the two, you either have pent-up demand, as we did between 1998 and about 2008 when it began to crash, we began to lose so many jobs, to oversupply, which is what we have right now because of that loss of jobs. It's a bit larger than what we faced last time. This is surprising that most states, this is much more severe than last time. California's recession is only slightly more severe than last time. Some of you don't remember the pain of the early 1990s. I do, and it was pretty bad, and it took a long time to crawl out of that. We're in a similar situation, even a little bit more severe. In terms of housing valuation, you can do well in an oversupplied market if you're also undervalued. And with tightened lending and the job losses and the recessionary impacts, we're severely undervalued right now, especially when you add to that extremely low mortgage rates. Here's the level of undervaluation. Something to point out is that this level of undervaluation is as unstable as it was back in year 2006. The only difference is it's the flip side of that. It has to correct, and the way it corrects is a combination of rising mortgage rates as well as appreciation. That occurs as the economy begins to recover during the next few years. Here's what overall median prices do. Even by year 2015, we're still below where we were during the peak years of the previous cycle. Here's the overall percentage changes that you see. And I'm going to tie that into our opportunity risk report in this last minute, where here's our index. What it shows is that based upon a stable index in 2008, we're stabilizing in year 2010. There's a 24-month lead to this. 2009 and 2010 were strong indexes. That means that 2011 and 2012 ought to be pretty strong years for the market, not necessarily because of economic growth or underbuilding. We'll actually be overbuilt. It's more because of severe undervaluation. My last chart is a long-term forecast of appreciation. I've shown this before. I'm sticking with this. It's come to pass so far, and I think it continues to do so. What it spells is that there's this land acquisition opportunity that is still open. I know the prices were bid up a bit too high during the past 6 months, and there's some buyer's remorse, but that acquisition window is still open for a couple of years. We're right at the base of that next turn up in the cycle. We think it peaks at about 2017, 2018 with double-digit appreciation again. Nothing new. We've gone through that 3 times since the 1970s. So in summary, California's economy has suffered massive job losses. It's just beginning to recover. We won't see that year-over-year job growth until first quarter of next year. Housing construction is at an all-time low, very difficult to get financing. Housing affordability is at an all-time high. Distressed housing inventory remains very high, but it's trending downward. Marginal price appreciation has already begun. We think that continues, unfortunately, for the next 6 months. It's at a lower level than it has been during the past 6 months. Transactions will fall during the next 6 months due to the expiration of the federal tax credit and tightened lending. We really borrowed demand for the first half of this year, or from the latter part of this year to the first half. Recent market changes, improvements were being driven by valuation as opposed to economic growth with very strong values. And the mature market should play a significant role in this next cycle. We invite you to take advantage of our services at Real Estate Economics, including our consulting services and our web-based information tools. Here's our contact information. Thank you all for joining us this morning. I apologize for talking so fast, but hopefully you'll find this information useful. Take care. We hope you will join us next week.